Imagine being like 21 years old right now. You're 5 times more likely to be investing in the stock market than your grandparents were at your age.
Right.
You've got these complex trading algorithms right there on your phone. But at the exact same time, you're intentionally taking on credit card debt to fly to Bali because you've basically mathematically accepted you'll never be able to afford a home.
Yeah, it's a wild contrast.
It really is. Welcome to Saturday, April 25, 2026. Today, we're dissecting the great financial paradox of Generation Z. I'm so glad you're joining us today because we're looking at a generation whose financial rulebook doesn't just look different from the ones before Likesway. I mean, it looks completely contradictory.
It really is a fascinating puzzle. On paper, their behavior just looks entirely opposed to itself. We're seeing this hyper-saving and really aggressive investing running totally parallel to what looks like, well, basically reckless, nihilistic spending.
Exactly. And to figure out exactly why they're acting this way, we're pulling from a phenomenal stack of sources for today's deep dive.
Okay.
We're not just looking at one survey here.
Right, you need a broader view for this.
Yeah, so we're cross-referencing global data from the CFA Institute on Gen Z investing, an Oliver Wyman Forum report on their spending habits, along with some really brilliant psychological analysis from the Business Times and the Independent Singapore.
Oh, those are great sources.
They just really are.
Yeah.
Our mission is to decode the mechanics of this behavior.
So, okay, let's unpack this. Because before we can understand how Gen Z spends or invests a single dollar, we really have to understand the economic baseline that is shaping their entire worldview right now.
That is the perfect place to start. You really can't analyze a generation's financial habits without looking at the ecosystem they're just trying to survive in. And the crucial concept here, and this was highlighted in that Business Times research, is something called the experience effect.
Okay, the experience effect.
Yeah, it's based on this foundational research by Ulrich Malmendier at the University of California, Berkeley.
So let's break that down for the listener. What does the experience effect actually mean, like mechanically? How does it rewire someone's brain? Well, the underlying mechanism of the experience effect is that dramatic economic events don't just, temporarily alter your budget. They leave a permanent neurological imprint on how you form financial beliefs for the rest of your life.
Oh, wow. So it's not just a passing phase.
Not at all. Think about it. For roughly 3 decades, inflation in the U.S. and Europe was basically asleep. It just hovered around 2%.
Right.
It had very little bearing on millennials or Gen X when they were forming their adult financial habits. But Gen Z, they've just experienced sustained, crippling price growth during their most formative psychological years. They literally watched the cost of basic survival skyrocket right as they were entering the workforce.
That makes total sense. I mean, think about your own baseline for money. If you grew up in the 90s, your financial baseline was shaped by stability,
Right.
steady growth.
Exactly.
But for the 16 to 24-year-olds we're talking about today, their entire formative baseline is volatility. The data from the sources shows that over 60% of Gen Z globally feels significantly impacted by inflation.
That's a massive portion.
It is. And in the UK, that 16 to 24 age bracket has seen the biggest jump in inflation expectations of any age group since the pandemic. Like, they aren't treating this as a temporary blip at all. They're assuming high inflation is just the permanent normal state of the world now.
Spot on. They are operating under the assumption that cash is just a rapidly depreciating asset. And when you combine that deep-seated inflation trauma with the current mechanics of the housing market, well, the psychological picture gets incredibly bleak.
Bleak is an understatement, honestly.
Right.
Look at the data from the National Association of Realtors. In 1991, the median age of a first-time homebuyer in the U.S. was 28.
Wow. 28.
Yeah, and recently, it's skyrocketed to 40.
That's huge.
Right. That isn't just a slight delay in a milestone. That's an entire life phase just completely erased. The goalposts haven't just been moved, they've been unbolted and completely taken out of the stadium.
And that data point perfectly explains the Harris Poll finding, where 46% of Gen Z believe that no matter how hard they work, they will never be able to afford a home they love.
Almost half of them.
Yes. They aren't saying it's hard. They're saying they have crossed a threshold where homeownership is just mathematically impossible based on median wages versus asset prices.
So, I mean, if you're staring down a math equation where homeownership equals 0, your relationship with money fundamentally breaks. You stop viewing money as a tool to build a secure future, and you start viewing it as a depreciating asset for the present.
Exactly.
And that psychological shift is exactly what researchers are calling doom spending.
Right. If we connect this to the bigger picture, this behavior is frequently dismissed by older generations as simple financial illiteracy or, just young people being financially irresponsible.
Which is such an easy trap to fall into.
It is, but when you look at the data, it's actually a completely rational psychological response to a system they feel is irreparably broken. Traditional milestones are out of reach, so they are fundamentally shifting generational preferences away from physical assets like real estate or expensive furniture and toward immediate consumable experiences.
Yeah, there's a quote from a Gen Z individual in the Independent Singapore article that perfectly captures this mechanism. They said, when there's an expiration date on money and it's devaluing fast, you have to spend it immediately.
That is a powerful way to frame it.
It's like holding a melting ice cream cone, If you don't eat it right now, it's going to disappear anyway, so why bother trying to save it? And the Oliver Wyman data backs this up with hard numbers. Over 80% of Gen Z are maintaining or increasing their travel spending, compared to just 72% of older generations.
But they're being strategic about it, right?
Exactly. They aren't just throwing money away without a plan. They're heavily rationing. They're prioritizing price over personal preference just to make that travel happen, while drastically cutting back on buying apparel, furniture, and major appliances. They're aggressively starving certain budgets just to feel alive and have experiences in others.
It's an economic coping mechanism, really. But remember, the core theme of this deep dive is a paradox. Because while half of this demographic is doom spending and feeling entirely hopeless about traditional milestones...
Oh, right. The other half is doing something else entirely.
Exactly. A massive portion of them have looked at this exact same broken system and drawn a completely different conclusion. They've realized that if traditional saving in a bank account is a losing battle against inflation, the only way to survive is to aggressively, actively grow their money.
Okay, here's where it gets really interesting. Because they are bypassing traditional banking infrastructure entirely to do it. The CFA Institute study reveals that 45% of Gen Z are already investing.
That number is wild.
Let me repeat the scale of that because it's staggering. By age 21, almost half of them are in the markets. That makes them 5 times more likely to be investing than boomers were at that exact same age.
5 times?
Yeah, and a quarter of U.S. Gen Z investors started before they even legally turned 18. They are the most aggressive young investors in modern history.
It's a completely unprecedented entrance into the financial markets. The sheer volume of young retail investors has fundamentally altered market dynamics. And the mechanisms of how they're learning to do this are just as fascinating as the fact that they're doing it at all.
They're learning through the screen, right. 60% use YouTube as a primary source for financial education, heavily relying on TikTok, Instagram, and Reddit.
Yep.
Now, I know it's easy to roll your eyes at that, but the CFA data shows they are surprisingly skeptical consumers of information. They don't just blindly trust some teenager dancing and pointing at stock tickers on a 30-second TikTok.
Far from it. They actually have a highly tuned radar for inauthenticity. When evaluating online financial creators, they apply very strict criteria.
Like what?
Well, they value clear, jargon-free explanations. They look for information that is highly relevant to their specific income brackets rather than, generic wealth management advice for millionaires. And crucially, they actively look for creators who can prove they aren't just shilling a sponsored product or trying to sell a course.
They want receipts.
Exactly. They demand to see the creator's actual portfolio. They want skin in the game.
That makes a lot of sense. But let's look at how they actually execute these trades, because Gen Z has essentially replaced the stuffy Wall Street advisor in a tailored suit with a supercomputer in their pocket.
That's a great way to put it.
65% of Gen Z investors use dedicated investing apps to make trades, compared to just 38% of Gen X. And this next stat is the one that really gave me pause. 69% of these app users say they get direct trade suggestions from the app's interface.
Right.
And 67% actually follow those digital suggestions to execute a purchase. So I have to jump in and play devil's advocate here. Isn't there an inherent danger in letting an algorithm, literally a piece of proprietary code designed by a corporation to maximize engagement and trading volume, prompt you to make life-altering financial decisions?
It's an incredibly valid concern, and we're actually seeing global regulators closely monitoring the gamification of finance for exactly this reason. But we have to look objectively at why these apps have achieved such massive market penetration.
Because they're easy to use.
Partly, yes. But historically, the biggest barrier to investing wasn't just knowledge, it was capital. You needed thousands of dollars just to open a brokerage account. These modern apps allow Gen Z to start investing with literal pocket change through fractional shares and micro-investing.
Oh, right. The barrier to entry is gone.
Exactly.
Hmm.
For 67% of U.S. Gen Z investors, the sheer ability to start small was the primary catalyst for entering the market. It entirely removes the intimidation factor. And to your point about the algorithms leading them off a cliff, the data shows they aren't just blindly tapping buy on push notifications in a vacuum.
They aren't.
No, 60% of Gen Z investors use 4 or more separate resources to cross-reference financial information.
Oh, wow. So the app might prompt them, but then they jump over to Reddit to read the sentiment, watch a long-form YouTube video explaining the company's fundamentals, and maybe text a friend before they actually commit the capital.
Precisely. The app acts as the catalyst, lowering the barrier to entry, but they're still doing rigorous multi-platform reconnaissance before they actually deploy their funds.
Okay, but that leads us to the critical next step. What exactly are they buying when they deploy those funds? Because Section 1 just taught us they're operating from a place of deep financial despair.
Right.
They're terrified of inflation eating their purchasing power, so they aren't logging onto these slick apps to buy the safe, boring, low-yield index funds their grandparents relied on, right?
Yeah.
They're actively chasing massive, high-risk yields.
They absolutely are. And in the United States, cryptocurrency is the undisputed king of their portfolios.
It dominates. 55% of U.S. Gen Z investors hold crypto, compared to 41% holding individual stocks and only 35% in mutual funds.
It's a huge shift.
And we have to talk about the psychological driver behind this, because a lot of it is fueled by pure emotion. Half of all U.S. Gen Z investors openly admit they have made an investment purely driven by FOMO, the fear of missing out. And when they act on that FOMO, the data shows they're most frequently jumping into volatile crypto assets or meme stocks.
And we really can't ignore the severe vulnerabilities this creates. While they're investing at record-breaking rates, the broader data shows that 32% of Gen Z currently carry more debt than they have in savings.
Yikes. That is a very thin financial tightrope.
It is, and the CFA study documents a very clear empirical link between frequent gambling and these high-risk investments. Almost half of Gen Z investors who classify themselves as having a high-risk tolerance are gambling at least monthly.
That's a huge overlap.
It's massive. They're the ones most likely to be buying NFTs, trading on margin, or using complex options contracts. It's less like traditional investing and more like venture capitalism. VC firms know 90% of their startups will fail, but they bet big on a few, hoping for a 100x return to cover all the losses.
Right.
Gen Z is applying a venture capital mindset to their own personal finance because they feel the safe middle-class returns of 5 or 6% a year are just a guaranteed path to slow failure.
It's like a football team throwing a risky Hail Mary pass in the final seconds of a game.
Mm-hmm.
When you feel like you're down by 40 points, priced out of housing and battling inflation, a slow and steady mutual fund just won't win the game. So you throw deep with crypto.
What's fascinating here is what that 100x return actually represents to them. When we look at their motivations, they aren't necessarily trying to get rich quick just to buy luxury cars. The data reveals a highly pragmatic ultimate goal.
Oh, what is it?
47% of U.S. Gen Z investors rank having a sustainable source of income outside of their primary job as their top financial priority.
Like, they want out of the traditional labor market entirely.
Exactly. It's fundamentally about independence.
Yeah.
They've watched millennials and Gen X get laid off during economic downturns, struggle with stagnant wages that don't keep up with housing, and deal with relentless corporate instability.
So they're building their own safety nets.
Yes. They're taking substantial, sometimes incredibly dangerous financial risks because they feel their generation's unique macroeconomic circumstances demand it. If the traditional W-2 job won't guarantee a roof over their heads or a secure retirement, they feel obligated to build an alternative safety net themselves, even if they have to leverage risky assets to build it.
Man. Which is an incredibly heavy burden for a 22-year-old to carry. But if the landscape is this volatile and the risks are this extreme, why do some Gen Zers succeed and build actual wealth, while others just fall further into debt?
That's the million-dollar question.
Right. I mean, we have all these algorithms, apps, and YouTube videos supposedly democratizing financial information. But the data shows the real deciding factor of success isn't a viral TikTok video or a slick trading interface.
No.
It's the traditional bank of mom and dad. And this plays out very differently depending on where you look in the world.
Family wealth and familial influence are really the invisible hands shaping this entire generation's financial reality. The democratization of finance through apps is, honestly, only half the story.
The numbers here are stark. 68% of Gen Z investors have parents who also invest. 79% of them actively discuss their portfolios with their parents. Now look at the non-investors, the ones being left behind.
Right.
They still rely mostly on their family for financial information, but only 30% of their parents actually hold investments. I mean, you simply can't learn what your teachers don't know.
And it goes far beyond just passing down advice. We are talking about direct capital transfer here. Gen Z investors are vastly more likely to have received a cash gift of $10,000 or more from their family, or to expect an inheritance of that size compared to the non-investors.
And the CFA study gives us a brilliant global perspective on how this dynamic shifts depending on regional economies. The contrasts are amazing. Take Canada, for example.
Oh, Canada's numbers are fascinating.
They boast the highest rate of Gen Z investors globally at 74%. And unlike the desperation we see in some other markets, Canadian Gen Z is highly driven by curiosity. They have a strong adoption of financial tech, and because their economic baseline isn't quite as pessimistic as Europe's, they view investing as an exploratory, proactive wealth-building tool.
Which is a much healthier mindset.
Yeah, and they also have a much higher median investment amount than the US or the UK.
Then you look at the UK, which presents a far more pessimistic data set. They are the least confident generation in the entire global study.
Which is so sad to see.
It is. Unlike other regions that have essentially given up, their top priority is actually still trying to buy a home, but they're uniquely squeezed by stagnant wages, a housing market that refuses to cool, and the broader economic sluggishness post-Brexit. As a result, they are incredibly cynical. 26% of UK Gen Z investors believe they will have to work and retire over the age of 70.
Over 70. Wow. And then you pivot over to China, and the ecosystem changes again. Gen Z in China is the most financially confident group globally. But the mechanism driving that confidence is heavily reliant on family money. A massive 75% of them expect an inheritance of $10,000 or more.
That's a huge safety net.
Right. Interestingly, they heavily favor mutual funds and state-approved bank products over crypto.
And that's largely due to strict regional regulations on cryptocurrency in China. They
Right.
simply don't have the same access to it. But human psychology remains consistent. 60% of them are still heavily driven by FOMO. They just channel that speculative energy into mutual funds and approved equities instead of decentralized coins.
This global perspective really drives home how regional economic history dictates present-day behavior.
It absolutely does. And this brings us to a really fascinating piece of research from Tilburg University by Fabio Bragion. It looked at the extreme hyperinflation of the Weimar Republic in Germany during the 1920s. The researchers traced the descendants of those who lived through that specific economic trauma.
Wait, we're talking about inflation from a century ago.
Yes. They found that in the specific regions of Germany that experienced the most severe hyperinflation in the 1920s, the households living in those exact areas today still have noticeably higher inflation expectations and altered savings behaviors compared to areas that didn't experience it.
That is wild. So 100 years later, the economic trauma of a great-grandparent is still materially impacting a family's financial behavior today.
Precisely. It is transferred culturally through local community institutions and crucially passed down within families through dinner table conversations and inherited anxieties. Generational trauma is incredibly real, and it applies to economics just as strictly as it applies to psychology.
So what does this all mean? I have to ask the critical question here. If we are seeing that economic success for Gen Z is so heavily reliant on the bank of mom and dad, whether that's passing down a $10,000 check or passing down the generational knowledge of how compound interest works, is the system basically just a rigged race?
It's a fair question.
Are some Gen Zers starting at the halfway line while others are permanently stuck in the locker room?
Yeah.
Because if the apps don't replace the parents, how do the non-investors ever catch up?
This raises an important question, and it's where the data points us toward the only viable systemic solution, which is formal financial education. The CFA study found that Gen Z non-investors are nearly twice as likely to have had zero formal financial education compared to those who do invest.
Twice as likely. I mean, that is a structural failure.
It is. If a young person doesn't have parents who can teach them the mechanics of risk tolerance, or how to spot a pump and dump crypto scam, or how inflation erodes purchasing power, the only place they can get that foundational knowledge before they're thrown to the algorithms on social media is in the classroom.
Right.
Improving financial literacy in schools, making it mandatory at the high school and university level, is the crucial step to leveling the playing field. It is the only proven mechanism to break the cycle for those who don't have generational wealth or inherited knowledge to fall back on.
That makes perfect sense. Education has to become the great equalizer when family wealth simply isn't there. Well, to bring this all together for you listening, Gen Z is navigating an incredibly hostile and totally unique economic environment. They are carrying the heavy psychological scars of inflation. They are armed with algorithmic supercomputers and trading apps. And they're being forced by the math of the housing market to completely rethink traditional milestones.
That's a lot to deal with.
It really is. Whether you're an employer trying to figure out how to retain young Gen Z talent who desperately want independent income streams, or a brand trying to understand why a 24-year-old won't buy a couch but will buy a premium plane ticket, or just someone trying to understand the changing economy, recognizing this new financial paradigm is absolutely critical.
It's a profound, permanent shift in how a massive sector of the global population interacts with capital.
And looking at this data, it's easy to want to point fingers at specific housing policies, central banks, or economic regulations. But our goal here today isn't to play politics or assign blame. We're just impartially sharing what the sources tell us. It's simply to look clearly at the dashboard of this economy and understand exactly how the newest drivers are navigating the road ahead of them based on the reality they see through the windshield.
And as we wrap up, I want to leave you with one final thought to mull over. We just talked about how the hyperinflation trauma of the 1920s in Europe is literally still influencing family financial behaviors today.
Right.
If economic trauma can be inherited across generations with that kind of lasting power, what kind of permanent radical financial habits will today's Gen Z eventually pass down to their own children 50 years from now?
That is a staggering thought. If they're operating with this level of risk tolerance and institutional skepticism now, what will their kids' financial rulebook look like in 2076? We started this conversation talking about a paradox, the feeling that money has an expiration date, so you might as well enjoy the experience right now, even while you try to outtrade inflation on an app. It seems that until the underlying economic math gets fixed, Gen Z is going to keep finding near unpredictable ways to survive the heat. Thank you so much for joining us on this deep dive. We hope you leave feeling a little more informed, a little more curious, and ready for whatever we unpack next time. Take care.
If you found this episode helpful, do subscribe to my channel for more smart finance content. I'll see you in the next one soon.